Okay, so picking up where we left off, all of our adjusting entries have to fit in one of these four categories, and in each case we're recording an expense that actually took place or a revenue that hasn't been recorded yet, and we're updating the balance in either an asset or a liability. And so in each of these, I have either an expense or a revenue, and then I have an asset or a liability as the offset. And then depreciation's the easier one there. So let's do a couple examples. In this one, we prepaid 6 months of rent. So the money's happening first, and then the activity's happening later. So this is a deferred, and rent will be an expense of mine. So this is a deferred expense. And so if I check back to my little chart, which you can keep handy, a deferred expense, I'm going to debit an expense, and I'm going to credit an asset. So for the adjusting entry, the first thing they ask you to do is to record when I actually received that, or when I made that April 1st payment. So on April 1st, I would have debited the asset prepaid rent, and I would have credited cash for the $4,200 that I paid. And now, at April 30th, 1 month has passed. So I paid for 6 months worth, and now I've used 1 month of that. So I need the balance in this asset to come down to show that now there's only 5 months worth there. Like for instance, let's say a month later I decide to cancel this. They're not going to give me $4,200 worth because I've used a month of that, right? So how much, I need the prepaid rent to show how much I could get back if I canceled. So if I divide the $4,200 by 6 months, that means my rent is $700 a month. So for the month of April, I need to record a rent expense for $700, and I need to bring the balance down in prepaid rent by $700. So on April 30th, my adjustment will be a debit to rent expense and a credit to prepaid rent for $700. So if we look at, they're asking you to do the T accounts, and I'm not going to do them all here, but if we look at prepaid rent, on 4/1 I debited it $4,200, and now on 4/30 I credited it $700. So the balance in there now is $3,500, and that's what I want it to show. That's what it's worth to me now, since I used a month of it. If I were to cancel it now, say they would give me $3,500 back instead of the $42, because that's the amount that they still owe me. So, and then I'll let you do the other T accounts. I'm not going to do them all, or this video will last forever. So, okay, so here's another very common prepaid expense that you see. This is office supplies. And so what they're telling us, we're going to start with the T account here for office supplies. And so they're telling me that I started with $1,300 on hand here. Hold on.
Call from unavailable.
Okay, so I started with $1,300, and this is an asset. Sorry about that. This is an asset, so that's a debit balance, right? And then I made an additional purchase of $1,400 during the month. So right now I have $2,700, and then they're telling me that at the end of the month I have $1,200 left. So I need this balance to show $1,200. That means I need a credit in here for the difference. So the adjustment is always recording what was used, what happened. So the revenue that was earned or the expense that took place. And so $1,200 is not the amount of my adjusting entry. Now this is a prepaid expense, so I'm going to debit an expense, which will be supplies expense. I'm going to credit an asset, which in this case is office supplies. Because before I do the adjustment, it's showing a balance in here of $2,700, but I don't have that much. So I need to credit this office supplies to bring it down to $1,200. So the difference here, 27 minus 12, is $1,500. So that must be my credit. That must be what was used. So I'll credit this supplies expense for $1,500. Debit supplies expense, credit the office supplies, and now the balance in the ledger account will be down to, if I had 2,700 and then I credit it 15, that'll bring this down to 1,200, and so that will actually show me. Then now this will match what I physically have on hand. And then the supplies expense would just be a debit on that T account. You'll see the supplies written two ways. Sometimes they say the amount of supplies used was $800, and then that is the amount of your adjusting entry. But if you have a beginning and an ending balance, you have to subtract to figure out what happened, and what happened is the amount of your adjusting entry. Okay, so depreciation. Now, depreciation is when we kind of use up an asset. And the adjusting entry part of it is really easy. Every time I see depreciation, I know I'm going to debit depreciation expense, and in this case it's depreciation expense equipment, we'll say, and I'm going to credit accumulated depreciation equipment. In most of the problems in here, they're just going to tell you, here's the amount of the depreciation expense. In this particular problem, they want you to figure it out. We'll spend a whole chapter on figuring out depreciation in chapter 10, but for now I just kind of want to show you. They're saying in this one that they paid $2,800 for this. They're going to use it for 4 years, and at the end of that it's going to be 0. So the value at the end of its life is called the residual value. So to calculate depreciation using the straight line method, which is the simple one, I just spread it evenly over the life. So I take the cost of the asset minus whatever it's worth at the end, the residual value, and then I just divide that by the useful life. So in this case, I paid $2,880 for it. It's worth 0 at the end of its life, and I'm going to use it for 4 years. So if I divide that, my annual depreciation is $7,200 per year. But I'm doing this monthly, so I'll divide that by 12 months, and my depreciation is $600 per month. So that is what that's what my depreciation would be for this month. So I'll debit depreciation expense $600, and I'll credit accumulated depreciation for $600. And then they want you to post those, and so I'm going to do all 3 of these just because I want you to kind of see what happens here. So the computer equipment, when I bought it, I would debit it $2,880. And then for my adjustment, I've got depreciation expense. Here, I'm going to switch this over. Accumulated depreciation. And I credited that $600. And then here's my depreciation expense, $600 here. And so the last part of this question says, what is the book value? And the book value is whatever's in the asset minus whatever's in accumulated depreciation. So in this case, that's $2,880 minus the $600, so $2,820 is the book value. The next month, for example, because they do the same I'm going to change colors just so we can see, but the next month they would do this exact same transaction again. They would debit depreciation expense and they would credit accumulated depreciation. And so what we'd see is now the next year the book value would be the $2,880. I never go back and touch that original asset. Now the accumulated depreciation is up to $1,200, and so here's the asset. Here's the accumulated depreciation, and so the book value is now $27,600. And then the next month I would do it again. $600 here. I would add another $600 here, so this balance would be up to $1,800, and this would be down to $2,700. I think you can check my math, but now it would be $2,880 minus $1,800. Yeah, and I'd be at $27,000. And so each month, the accumulated depreciation keeps going up, and the book value keeps going down, and the original equipment stays the same. So I don't think you have to do too many of these in here where you have to figure it out. And so if they give you the amount of depreciation, then that's all you have to do, and this becomes probably the easiest of your adjusting entries. Because as soon as they start talking about depreciation, you debit depreciation expense and credit accumulated depreciation. Accumulated depreciation is what we call a contra asset, so it's the opposite of an asset. Okay, so here's one for an unearned revenue. So again, this is a deferred revenue. So the money takes place first, and then the action takes place later. In this case, I'm getting paid up front, and then I'll perform the service later or provide the product later. So this is a magazine that collects cash in advance. So we're going to first record here when we got paid. So we debit cash, and we were paid in advance, but we haven't done anything yet. So we will credit the liability unearned revenue. And we did this in the last chapter. That's not anything new. And now they're saying, okay, so now it's sometime later, and we have actually earned 9,000 of it. So we didn't actually record any revenue here, right? Because this is a liability. So now we want to recognize that revenue. And the other thing we're saying is that we don't owe as much now since we provided it. So we're going to debit the liability, which will be unearned revenue, and we're going to credit the revenue, which I think in this case is subscription revenue, for $9,000. And so that recognizes the revenue that I received, and that will update the liability. So the liability unearned revenue, we started with a credit balance of $150,000, and now we just debited it $9,000. So what I owe is down to $141. That's the balance in that account, and that shows that's how much I still owe them. So again, once you recognize what this is, as soon as I've been paid in advance, the adjusting entry is always going to be a debit to unearned revenue and a credit to whatever your revenue is. All right, here's ones for accrued salaries expense. So this is accrued expense. So the activity takes place first, and then the money will come later. And so if I go back to my original chart, I see with this one I'm always going to debit an expense account, and I'm going to credit a liability. And for these guys, these always go together. So this is salaries, so I'm expecting that I am going to debit salary expense, and I'm going to credit salary payable. Now, how much am I going to do that? That becomes the trick. The who you're going to debit and credit is fairly easy. As soon as you see the salary, you know this is what it's going to be. But let's figure out how much. So this place has a weekly payroll of $7,500. December 31st, when I'm doing my books, falls on a Wednesday. They pay their employees the following Monday for the previous week, and they have a 5-day work week. So what this will look like: so Monday, Tuesday, Wednesday, Thursday, Friday, and then they'll pay the following Monday. So in this case, that's January 5th, and so next Monday I'm going to pay out $7,500. But if I divide the $7,500 payroll divided by 5 days, then the pay per day is $1,500. And so that's for each day, $1,500, $1,500, $1,500, and $1,500, and then I pay the whole thing out next Monday. They're telling me that December 31st falls on a Wednesday. So let's say these are 29. These are 2016, okay? I'll put that there, 2016, and then January 1st and January 2nd, these are 2017. So even though the payroll is still $7,500 and it gets paid at its usual time, the important thing here is that $4,500 of that payroll occurred in 2016, and the other $3,000 occurred in 2017. So I need to make sure this $4,500 gets included with the expenses for 2016, and the other $3,000 will get included with the expense for 2017. Okay. So so here's let's go back to here's my payroll here. So I want to include, this is the end of 2016, this is the last day, so I want to include this part in here. So I'm going to debit salaries expense and credit salaries payable for $4,500. That's 3 days worth of payroll, because that's what occurred in 2016. Now the employees don't see this or anything. So then the last part says, okay, now record the payment. All right. So I'm going to run out of room here. So the cash that I'm paying out is going to be the $7,500. That hasn't changed. But I don't want to include the whole thing in salary expense because I already included $4,500. So this amount here that I set in the payable, now that's going to come out. So I'm going to debit salary payable for the $4,500 that I stuck in there. So I stuck it in there as a holding pattern. It's just going to sit there for 5 days, and now it comes back out. So it's a liability, so I credited it. Now I'm going to debit it, and it'll clear it out. And then the rest of the payroll, the other 3 days, the other 2 days here, that becomes an expense now for this year. Because now, when I do this one, this is January 5th, 2017. And so I want to include these 2 days as an expense for this year, because that's when they took place. And then I just pull out the payable, what I already put in there. So this is what that one looks like. If December 31st had fallen on a Tuesday, then I would have $3,000 here in 2016. That's what would have been in the payable, and then the rest of it in 2017. You'll see some of those in the homework problems, but hopefully that little explanation makes sense. Here's an easier one, but this is still an accrued expense here. So I'm going to debit an expense, and I'm going to credit a liability. So, and in this case, they're telling me how much it is here. It's $494. So I borrowed money, and generally when they do these notes, a lot of times they pay the interest like twice a year or something. So I might not have to pay for another couple months or something like that. But I'm doing my books now. I might make my payment to the end of December or something. But I'm doing my books now, so I want to record that. So I just debit interest expense for $494, and I credit interest payable, $494. And that's all I have to do that one. So they've given me the amount. I don't have to work for that. And as soon as I recognize that this is an accrued expense, I debit an expense and I credit a payable. And they pretty much always kind of have the names that go together with them like that. And here we have at the end of June, Galileo Dental performed $8,000 worth of dental services but had not yet billed customers. And that's probably fairly common because they're waiting for the insurance and that kind of stuff. But the revenue happened this month, so I need to record it this month. So this is an accrued revenue. If we go back to our chart, we say every time we do an accrued revenue, I debit an asset and I credit the revenue. And the asset is always, for this one, going to be accounts receivable. So I'm going to debit accounts receivable, $8,000, and then I'm going to credit service revenue, $8,000. So again, once I figured out what it is, the journal entry is pretty much always the same for that. And then okay, so I think I'm going to stop this here and post this part, and then I'll come back for the rest of the chapter where we just do an adjusted trial balance and introduce you to the worksheet. I'll be right back.